Well, good morning, everyone, and welcome to Talks at GS. Henry Kravis is the co-founder and co-chairman and co-CEO of legendary global investment firm KKR, which he's been leading now for over 40 years since its founding in 1976. Thank you for being here today.
Thank you for having me. This is quite an honor. Thank you all.
All right, so why don't we talk about KKR and the founding of KKR?
So in 1976, we'd made a decision, the three of us, Jerry Kohlberg, George Roberts, and I. And by the way, you have to understand, George and I are first cousins, grew up together, been friends since age 2, and we wanted to focus just on private equity. That was not what it was called in those days. What it was called was bootstrap acquisitions. And then it became management buyouts, and then it became leverage buyouts, and then it became private equity. And the firm at the time, and actually through its history, was an institutional sales and trading firm, and really had a very small investment banking business, and certainly no interest in anything in private equity. In fact, every time we'd buy a company, we'd have to scramble around for the money, and couldn't, because the firm never put any money in it. So we went to see him and said, we would like to focus on private equity, and we'd like to give Bear Stearns a half interest in this new vehicle we'll set up within Bear Stearns, and we'll keep a half interest. And as luck would have it, immediately he said, no, we have no interest. You're either here or you're out. Well, thank God for that answer. And because that enabled us to then be on our own and go out and raise our own money and be our own bosses.
You built an industry, and did you realize at the time how transformative what you were doing would be for the markets?
One of the things that I always like to ask a CEO when I'm sitting down with them, and I say, you're here today with your company, where do you want to be 5 years from now? And I love the body language in most executives, because for them, 5 years is music to their ears. You know, most people come in, the analysts come in, and they say, what are you going to do next quarter or next 5 minutes? And so they can't run the business the way they want to run it. And so we literally like to take a long-term view, and we always have taken a long-term view, and that's really critical to how we create value. Our job really begins the day we buy a company. We like to say to people, don't congratulate us when we buy a company. Any fool can buy a company, you just pay enough. That's the easy part. To make an investment, that's the easy part. The hard part is, what do you do with the business once you have made your investment? How do you create value? What do you do to make that company much more efficient? And with a lot of younger people, I find at KKR, the hardest thing for them to get over is they'll run models. And the models are wonderful. And we used to get big stacks of paper and all of this. And I'd basically look at it and I'd throw it out. And I said, doesn't mean much. And they'd say, well, what have you done? I spent, the last 3 days running this model. I said, well, that's all fine. But I said, what happens if I change the working capital assumptions? What happens if all of a sudden we can refinance the company in 2 years? What happens if we can sell a subsidiary at a huge price? When you invest, investing is a movie. It's a series of still shots. It is not a photograph. And too many people look at something, they look at the model, and they will say, well, we're going to earn 18.76%. They're very proud of the fact that that's what it's going to be. I can guarantee you, everybody in this room, that we will never earn on an investment 18.76% if that's what the model shows. We'll either be higher or we'll be lower, but it won't be that. And the reason is, there's so many things that you can do to improve a business, to make it better, to merge it with somebody else, to go to China, which you hadn't thought about doing, and so forth. And so, investing today is really one of a series of events. And what can happen, I always say to people, I said, to be a good investor, you have to be curious. And too many people are in their silo. They're in a box, and this is how they do it. They sit in front of the computer, and I try to tell them, get away from the computer, Garbage in, garbage out. Go out and meet people, talk to them, and you don't have to have every single answer. It doesn't matter how many blue trucks, I like to say, a company owns. What's more important is what can you do with the business in the 20% that'll really drive the results and drive the outcome. What can you do with that to create more value? So a lot of things have changed, but a lot have still stayed the same, without a doubt. One last point I will make. What has stayed the same at KKR is our culture. Our culture is critical. When we started the firm, we had two parts of a longer conversation. Both weren't very long, actually. The first one was, how do we divide the firm? And we said, Jerry, you're 20 years older. You're running the corporate finance department at Bear Stearns. Why don't you take 40% and George and I'll each be 30, and the first 10 points we give away will come out of your 40, then we'll all come down together. And secondly, what kind of culture do we want to have? And this was critical to the firm, and we can talk about that later on. But to us, what was very important right at the beginning, we came from a firm which was an eat what you kill firm, Bear Stearns. It was what you produced, and at the end of each year, you walked in to your boss with a piece of paper and said, this is what I worked on, these are the fees that I created, etc. And we decided that when we started KKR, every single person at KKR was going to participate in everything we did, whether you're a partner at the firm or you weren't a partner, whether you worked on a deal or you didn't work on the deal, whether you lived in San Francisco, where one of our offices, where George was, or in New York, where Jerry and I were. Everyone was going to participate there. Today, 41 years later, and 21 offices around the world, lots of different businesses, we're exactly the same. And this is critical, I think, to what KKR is all about.
So KKR still thrives in the market, and what, apart from your culture, what has set you apart and allowed you to thrive through the decades?
I'm really a big believer that every 10 years or less, you have to take a step back and assume this is your first day on the job. You're the new CEO. You've just arrived at the XYZ company, and you got to take a fresh look. And that's what George and I have done at KKR. And so today, I'd say we move much faster than we did before. And it's part of our 100-day plan. It's part of our thinking when we do analysis than what we had before. I'd say there's a couple of other things that have really made a difference and helped us continue on. And that is, in addition to taking a fresh look at ourselves every 10 years or so, is constantly trying to reinvent ourselves, staying at the cutting edge. I have a sign in my office, which my assistant gave me many years ago, and she did because she'd heard me say it so much, arrogance kills. And I really truly believe that. I've seen more people blow up because they're arrogant. And there's no reason for anybody, in my view, to be arrogant there. And so we look at, how can we're making mistakes, we're all human, how can we do a better job at what we're doing? And how can we stay on the cutting edge? And, we'll talk about technology in a little bit, but it seems to me that if you don't take a fresh look, you don't get out of your comfort zone, you don't try new things, and George and I always say, well, you throw enough stuff up, something will stick. And that's really what we try to do, is constantly be innovative, trying to stay ahead of the curve, and we've had many of those events at KKR, and learn from mistakes. And God knows we've had plenty of mistakes that we've made, but sit down and correct them.
Let me pivot to the macro landscape, and could you talk a little bit about your general outlook for the U.S. economy throughout the rest of this year in 2018? And also Christine Lagarde of the IMF recently warned governments they could be experiencing a false sense of security right now. So do you agree with that perspective?
Well, let me just give you these are my personal thoughts on the economy. Look, we're almost through the end of 17, and obviously I think the rest of 17 is going to be fine. I actually think 18 will probably be fine too. I think you'll start seeing rates move more in 2018. Think about the strength that there is in the economy right now. But there's a lot of vulnerabilities as well. So I think that 2018 will get through probably fine. If I had to pick a time when you'll start to see a slowdown, it's probably going to be in 2019. Look, there's always the black swan that we don't know about. There's North Korea, there's just a lot of things that can happen. And everybody's looking for return. Everybody's looking for yield today. And one of the reasons the stock market has been strong is the hope that there'll be tax changes. As far as what Christine Lagarde is saying, you know, yeah, I think there's certainly vulnerabilities. There's no question about it. And, you know, just look at how hard it is for companies to grow their top line. Yes, bottom lines are growing fine because the companies are better operated today than they were in the past. But I can tell you from our own 130 odd companies, that push that we have toward trying to grow the top line, we're successful at it, but boy, we concentrate, and it's hard.
You know, one of the things you alluded to earlier is, you know, co-leadership and your partnership with George. So can you talk a little bit about why your partnership with George has worked, and were there any times that it didn't work?
Well, let me just give you a bottom line of this. George and I have probably the best relationship that any two people could have in business. It's been a 71-year relationship. We met when we were 2. People asked, well, you two must really fight a lot, right? I said, oh yeah, the last time we had a big disagreement, we both were 7. He wanted to ride my new bicycle, and I didn't want him to. And so I got chased in the house, and I ran in the corner of a wall, cracked my head open, and had 23 stitches. And I said, there got to be a better way than this. So no, we don't, you know, look, very simply, if you've got respect for the other person, if you've got trust in the other person, if you both believe in a common goal that you want to try to attain, and it's big, much bigger than you personally, then you can go a long way.
All right, so last piece of advice for the audience, bearing in mind, as I said earlier, that 60% of our people are millennials. If you had one piece of advice to leave the audience with, what would it be?
Well, this is a piece of advice I give startup companies a lot when I personally invest in them. We don't do it as a firm at KKR, but the one thing is get out of your comfort zone. You know, it's easy to stay in, you know, where you are, where you really feel comfortable, and get the heck out of it and open your eyes and test yourself, because you'd be amazed how far you can go, number one, if you just try. And number 2, be as curious. No one, in my mind, can be a great investor unless you're curious. And that means thinking about how to connect the dots, looking at a global view. I'm interested a lot in the arts. I'm interested in medicine, in the medical area, which I would put a lot of money into personally, and education. And in my view, you'd learn a lot, and you'll get my last point I would make to you, take a part of your day, a part of your time, and give back to society. That's critical. And I can tell you, those 3 areas, if you focus on curiosity, get out of your comfort zone, and give back to society, you're going to be really happy.
It's great advice.